Greetings, great hope learners. My name is Mr. Simbi, and welcome to today's accounting lesson. This lesson is brought to you by the Gauteng Department of Education in collaboration with Sabono Discovery Center. This is our first lesson in Term 2. In Term 1, we did a couple of lessons, and I'm sure if you need help with the statement of comprehensive income, the statement of financial position, we even covered the cash flow. You can still find the videos on this very same page. It will assist you as you prepare for your June exam. Now that we just have a few weeks before the June exam, we need to also focus on paper 2. So today I'm going to begin a new topic, which is inventory valuations. Some of you have already begun this topic in your schools and you are busy doing calculations. So in today's class, I'm going to show you how to do certain calculations on inventory valuation. You will need your calculator, you need a pen, you need somewhere to write. There is a worksheet that was released. So if you don't have that worksheet, you can ask your teacher if they can organize that worksheet for you so that it becomes easy for you as you do your calculations. All right, if you're ready, let us then begin. Here are my objectives for today's class. I will speak on the perpetual as well as the periodic inventory systems. I'll also speak on the inventory valuation methods, and there are 3 inventory valuation methods which I will speak of today. I'll also speak on other inventory calculations such as missing units and other financial indicators that we can calculate when we have done inventory valuation calculations. I also speak to internal control. What happens when stock goes missing? What can we do? And in some cases, we find we can be given questions where there are challenges with particular departments or particular shops, and how then can we solve such problems? All right, so to begin with, I'm going to talk on inventory systems. What are inventory systems? And you know that we have 2 inventory systems, namely your periodic inventory system and the perpetual inventory system. These are different methods used to track the quantity of goods on hand, okay? And then to begin with, let us speak of the perpetual inventory system. The word perpetual simply means continuously, ongoing, all right? So this perpetual inventory system, when we use the perpetual inventory system, stock items on hand are shown by the system at any point in time. This becomes very important, that when we use the perpetual inventory system, our stock on hand are shown at any point in time. This inventory management system uses the specialized automated software. So you need to have a computer, you need to have a specific software that you use that will assist you as you manage your inventory. And you will see that in most shops when you go, you see people that will be scanning using a barcode scanner. That is also how this inventory system can be managed. All right. And then we'll now speak to the periodic system. What is the periodic inventory system? With the periodic inventory system, there is no continuous recording of the movement of stock. Very key. That with the periodic, there is no continuous recording of the movement of trading stock. The value of the trading stock on hand is worked out, counted periodically. This system is mostly preferred by small businesses. Okay, and then you would see that these kind of businesses, they would then have less stock, so it becomes easy for them to manage it, and then they would only do physical stock taking because they have less stock to count. All right, so this is your periodic inventory system. And then now I want to draw some differences. Are there any differences between the perpetual inventory system and the periodic inventory system? With the perpetual inventory system, the movement of stock is recorded on an ongoing or continuous basis. The movement of stock. So we're talking about either the purchase of stock or the sale of stock. Once there is any movement of stock, we then keep a continuous record of the movement of stock. The exact quantities and types of stock items on hand are shown by the system at any point in time. Okay, so this is with your perpetual inventory system. With any movement of stock, we are able to calculate our cost of sales. We know the stock that we have on hand at any point because it keeps an ongoing record of our stock. And then grocery stores, supermarkets, and at times pharmaceutical companies such as pharmacies need to manage their stock. For groceries and supermarkets, these are perishable, and some of them can be non-perishable items. So you'd find that these outlets would then employ the perpetual inventory system. One of the other businesses that can use the perpetual inventory system are your pharmacies, all right, where you go and buy your medicine. They need to manage the expiration date and stock levels. Remember, when you buy your medicine, it must still be within the time period which you can use it. So they need a system that tells them of such information, how many units they have, and what is the expiration date. So a system that can be able to keep them updated is the perpetual inventory system, which keeps an ongoing analysis of their inventory. It keeps an ongoing record of their inventory. The physical stock taking is conducted to verify the stock on hand. So we'll still verify stock on hand by doing a physical stock taking. Okay, you will see, as I was saying earlier on, this is one of the examples where the perpetual inventory system can be used. And then let's look at the periodic inventory system. With the periodic inventory system now, there is no continuous recording on the movement of stock. Remember, we've said it already. With the periodic inventory system, inventory levels are only determined periodically, typically at the end of a specific accounting period. So we would know of our stock levels at a particular period, and in most cases, it is at the end of the accounting period. The value of stock on hand at the financial year end is calculated by conducting a physical stock taking. So as I was saying earlier on, such outlets would not have huge quantities of stock because they need to count them physically. So they need to have manageable stock levels. Hence, you would see it is mostly small businesses that may use this kind of system. Small retail businesses with limited inventory items and lower sales volumes may find it more practical to conduct a periodic physical inventory count. Okay, so stock amounts really play a major role. They must be at a point whereby we can count them physically. So, okay, and then from here we're going to now move on to the accounts that can be used when we are recording our inventory amounts. When we use the perpetual inventory system, when we have movements in stock, such movements such as purchases, when we acquire stock or when we sell the stock, such movements will be recorded in a trading stock account. So with the perpetual inventory system, when we acquire stock, it is recorded in a trading stock account. However, with the periodic inventory system, when stock is acquired and any other movements that pertain to stock will therefore be recorded in a purchases account. So you can see that with your perpetual inventory system, stock will be regarded as an asset because it's a trading stock account. So stock will be regarded as an asset. But in the periodic inventory system, we are going to open a purchases account. So stock will therefore be regarded as an expense. I'm going to move on now to the next aspect. Let's go on to the next aspect. The periodic systems, we're going to talk about the advantages and the disadvantages. All right. The advantages of the periodic inventory system: it is cost effective. It is not a costly system. It is not expensive at all. So it is cost effective. It does not require sophisticated inventory tracking software or barcode, scanning systems, making it accessible to smaller businesses with limited resources or expertise. So it is a cost-effective method whereby small businesses can use this one because it is cost-effective. That is one of the main advantages of the periodic inventory system. However, it has its own disadvantages, such as the control over stock is not very effective. So you would find that stock shortages may happen and stock can be stolen, and we may not even know that there is stock that has been stolen because we only get to know the stock levels at the end of the financial period. So stock shortages cannot be easily detected, and stock theft cannot also be easily detected. Because once we detect that stock is being stolen, then we can put measures in place. But with this system, stock theft can go on undetected until we get on to the end of a particular period. Theft is not quickly detected, all right, as I had said earlier on, all right, and you will not therefore know if stock is being stolen and how you can avoid such. That is one of the other disadvantages of the periodic inventory system. Let's come now to the perpetual inventory system. With the perpetual inventory system, I have quite a number of advantages. Let's go through them one at a time. The first one, the business can verify physical stock at any time. So because they have an ongoing record of their inventory, they can then verify physical stock at any given time because there is an ongoing account of stock. The business can prepare interim accounts. That is, before we get to the end of the financial year, we can still prepare some interim accounts because we have our stock levels readily available. Discrepancies, errors, shrinkage in stock are discovered and action can be taken. All right, so it is easy to identify and to detect any errors or shrinkage in stock, and therefore corrective action can be taken before we get even to the end of the financial year. That means we can be able to stop stock shrinkages at an early stage, unlike when you use your periodic inventory system. There are regular updates in stock, which then help in avoiding deterioration or the decline in quantity of stock and obsolescence. All right, when you talk about obsolescence, we're talking about outdated stock. Okay, because we have regular update of our stock. You remember, I was talking about a pharmaceutical company or a pharmaceutical retailer, that they will have information of their expiration date. That simply means it then allows them to know how to manage their stock levels in such a way that stock will not become expired within the shelves. In other words, they are able to detect the dates, therefore they can be able to avoid such challenges. And then the last one, stock can be replenished or replaced timelessly. Because we have stock figures readily available, we can know and predict if we are going to have stock shortages. Therefore, we can be able to add more stock on our shelves. That is when we use our perpetual inventory system. It has its own disadvantages, such as the system is complicated, it requires more accounting entries. Okay, and then it is very expensive to run the system. So you need a computerized system, you need computers as well, and you need employees that can be trained to work on the system. So you also need barcode scanners and other softwares and other gadgets that can be able to perform your accounting entries. Hence, we're saying it is expensive to run this particular system. All right, so we were talking about the perpetual and the periodic inventory systems. Okay, now we're going to move on to our inventory valuation methods. Okay, so don't confuse these two. First, I spoke about the inventory systems. Two inventory systems I spoke about. The perpetual, where we calculate continuously our stock levels. Our cost of sales is readily available at any point. And then we spoke about the periodic inventory system, whereby we only know of our stock levels at the end of a particular period, such as the end of the financial year. 2, stock systems. Perpetual. The next one is what? Periodic. And then we are going to now go to the inventory valuation methods. Inventory valuation. The purpose of inventory valuation methods is to give value to our inventory, because we acquire inventory at different times and at different cost price. So at the end of a particular period, we should be able to assign value to our inventory. That is what inventory valuation methods do. So now we have moved from the inventory systems. We are now on the inventory valuation methods. Inventory valuation methods. And the first method is your first in, first out, your FIFO or your FIFO, whichever way you want to call it. Okay? And then the second one is your weighted average, your weighted average. And then lastly, we talk about the specific identification. So I'm going to go over 3 inventory valuation methods. Let's see how far we can stretch today. All right? But I hope that today we should be able to completely do FIFO properly, do calculations, and we should be able to understand what this inventory valuation method is all about. Are you ready? Okay, if you're ready, then I think it's good that we now introduce our FIFO. The FIFO inventory valuation method. The first in, first out inventory valuation method is an accounting approach used to assign cost to inventory items based on the order in which they were purchased. So the order of purchase is very important when we use our first in, first out. According to the FIFO method, the oldest inventory items, those that we acquired first, are to be sold first. Okay, so inventory that is acquired first is the one that is to be sold first, while the most recently acquired items may remain in inventory. Okay, so you can see here that the idea is to sell the inventory that was acquired first, and then the most recent is kept in our inventory. Then retail businesses selling products such as clothing, electronics, we're talking your computers, your cell phones, home goods, and consumer goods. We're talking goods such as your yogurt, as you see here. They often use the first in, first out. This will be for obvious reasons then. You can see with your products such as your yogurt, these are perishable goods. So we would want to sell these goods in the order in which they came to the business. The stock that arrived first, we wish to sell that one, such that we do not have a problem of goods expiring within our shelves. And then this method aligns with the natural flow of merchandise, where older inventory items are typically sold before newer items. So we'd want to sell our older items before we can sell the new items. All right, so this is your first in, first out. We would want to sell the stock that arrived first in the business. That is what we want to sell first. First in, first out. That is the first inventory valuation method for today. Okay. We are going to have some calculations done. So I want to encourage you to have the NSE June for the year 2023. We're going to be focusing on paper 2 and specifically question number 2 of the NSE June 2023 paper. NSE June 2023 paper. All right. So I hope that you do have this worksheet. If you have the worksheet, then it's easy for you. If you don't have the worksheet, as I said earlier on, please speak to your teacher. They should be able to assist you to get that worksheet. Okay, now let's begin. We want to do simple calculations. We want to understand, how does this first in, first out method really work? How does it work? Okay. The activity that we're doing reads as follows. Mandy Jones is the owner of TV City that sells TV sets. So you can see in this question, they are using the first in, first out, and their products are television sets. And they have two branches, that is shops, in KZN. The periodic stock system is used. Very key to note that this business is using the periodic stock system. No missing items were recorded for the financial year ended 20th February 2023. So in this case, there was no missing items. There was no stock theft that was detected. All right. Required. Calculate the value of closing stock of the active TV sets on 28th February 2023 using the first in, first out. That is your FIFO method. Do you want to see the information? Okay, let's go and look at it. Here's the information that we were given. That's the information. We are given here our opening stock. So our financial year begins on the 1st of March 2022. This is the beginning. Okay, this is the beginning. And the financial year ends, as you see here. Now we have closing stock. This is where the financial year ends on 28th February 2023. And we have 270 units. Our task is to find a value that we put on this question mark. We seek to calculate the value of these 270 units. There is 270 units left at the end of the year. We seek to give them value. How much are they worth? Remember, when we prepare our financial statements, such as your statement of comprehensive income and your statement of financial position, we would want to know how much is the stock on hand at the end of the financial year. Okay. To those who are following some of the lessons that I have done before, you will find that when we're doing the statement of comprehensive income, this very same topic was also included in paper 1. I think some of you saw that. This very topic was also included as part of paper 1, where you can have calculations that affect the statement of comprehensive income and even the statement of financial position. All right. Now, what we want to do, as I said earlier on, is to calculate the value of these 270 units. We have units. We want to know how much are they worth. We know that in this question, we are using the first in, first out. All right. And we are told that the business has sold some units, and they have sold 1,550 units. So we know that if they have sold 1,550 units, our opening stock here, our opening stock of 280, these have already been sold. They have been sold because whatever came in first was sold first. So we sold the opening stock units before we even sold the purchases in May. Okay. There are several ways in which we can calculate our value of closing stock. We can begin from the top and we go all the way down, and then we know the value of closing stock. That is very possible. However, it is very time demanding. It will consume a lot of our time. And in the exam, time is one thing we do not have. So it therefore becomes very important that if there is a way that I can show you that will allow you to get the very same figure, but in half the time, why don't we do it that way? If there's a way that we can get the very same answer, but much quicker, still maintaining the accuracy, why don't we use it if there is a method like that? So, the understanding therefore is, if stock that came in first will be sold first. The opposite might be true. What is the opposite? Stock that came in last will be sold last. I hope I'm making sense there. Because if stock came in first, will be sold first, we want to see the opposite. The opposite would be stock that came in last will be sold last. Okay, that means we will now consider the last in to be the last out. Okay? In that case, I will stop focusing on my top. I will stop focusing on my top because I know that the stock that is at the beginning is already sold. That is not my problem. My concern is the closing stock. And the closing stock will be stock that has not been sold. What has been sold is no longer my problem. I want to know the value of what has not been sold. And which ones have not been sold? The stock that came in last. Last in, last out, because we're busy with the first in, first out. So I'm going to employ a method whereby we don't start from the top normal, but rather, let's look at the bottom. Let's look at the bottom. Okay. Now, if I'm looking at the bottom, it is very safe to say if there is any units left that have not been sold, considering that our business is using the first in, first out, the last purchase will be the one where we find our stock. The last purchase will be the one where we find our stock. So, if I want to know the value of my closing stock, I will not look at the top, but rather I'll look at the bottom. Now, in January, that is where I'll look first. How many units do you see in January? Can I hear you? Thank you. Someone says 300. Yes, you see 300 here. It is very important to note that before you even begin to calculate, you need to check in your question if there are any returns. That is, maybe we discover that the stock was defective, broken, damaged, wrong color, wrong texture. So we sent it back to the supplier. Returns in this case. If there are any returns, we need to subtract them. There we agree. The question is, where do we subtract them? Look here. We have 60 units that were returned, as they said here. But these 60 units, they were returned from which month? They did not tell us whether it's January, whether it's September, August, or May. But they gave us a clue. They gave us the cost price here. The cost price is how much? 4,100. Of the 4 purchases that were done in May, in August, in September, and in January, in which month do we find the cost price of 4,100? In which month? In the month of January. So that means these returns of 60 were purchased in which month? In the month of January. So I'll come in and I'll say, do I still have 300? I purchased 300, but then I returned. That means I subtract. I subtract how much? I subtract my 60. Do I still have 300? Certainly not. How many do I have? It is your 300 minus your 60. Tell me, how much are you going to get? Thank you. So here you're going to get 240. Very, very important. Before you even begin any calculations, look if there are returns. Once there are returns, subtract those returns so that you now know how much is the accurate stock on hand. Because once it's returned, it's no longer in the business. Okay. So, remember, we want to find the value of the 270. So what I did, I put these 2 boxes here for you. There's 2 boxes here for you. The first box, I'm going to put my units. How many units? 270. 270. We want to find their value in rands. That is what we want to do. Let's start now. So this is more or less like my foundation. Let's begin building. If I have 270 units left, it is very safe to say, of those 270 units, some of those units are from the January purchases because they were the last in. Therefore, they will be the last out. In January, do I have 300? No. How many do I have now? 240. Because the 60 were returned back to the supplier. So I'll come here, then I'll now say, I need 270 units. But from the January, I only have how many? 240. So I'll come here, then I'll have my 240 here. You following me? Yes. Then you have a 240 there. What is the cost price? What is the cost price in January? 4,100. So I'll come here, then I'll say, multiply it by 4,100. Let me see calculators. Let me see calculators. How much do you get here? Say it again. 984,000. Okay. Make sure your calculator is close to you. 984,000. Let me repeat what I've just done. We have realized that when we use the FIFO, the last purchases is what we are concerned about, not the opening stock, not the purchases in May. They've already been sold. What is sold is already with the customers. We want to know the value of what we still have in the business. And in the business, we will keep stock that came in last. So we focused not on the opening stock, nor in May, but we focused in January. But in January, we realized out of the 300 units we bought, we returned 60 back to the supplier. So we can't be having 300 anymore. We now have 240. Hence, we now say 240. Okay. But we know that our units on hand are how many? They are 270. Our units on hand are 270. That means our closing stock is not only made up of units in January. Now I look up now. From January, I look up. Yes, you can say it. From January, where do I look? I look up. Which month is up? September. In September. How many units do I have in September? I have 400 units. But here, I already have 240 of the 270. That means in September, some other units were sold. Which units were not sold? 270 minus 240, 30,000. 30,000. I say 270 minus 240, I get 30. 30, not 30,000, just 30 units. 30 units. Then I now say, those 30 units in September, what is their value per unit? Their value per unit is 4,000. The value per unit is 4,000. So it is 30 units, and each one has a cost price of 4,000. How much is that? On your calculators, please. 120,000. Thank you. 120,000. Now, let's come and get the answer now. So we are now saying, if I add my 240 and my 30, I get the 270, which is the units on hand. So it means if I add my 120 and my 984, I should get that question mark there. How much is that? 120,000 plus 984,000. How much do you guys get? 1 million, say it again, 1,104,000. 1,104,000. Hey, boys and girls, this is your first in, first out. This is your first in, first out. Yes, this is how simple it is. You don't have to focus on the top. You simply focus at the bottom. The stock that we bought last will be the ones to be sold last. So we focus from the bottom. Then we look all the way up. We need how many units? 270. 270 over here. The first one in January. Not 300, but 240. I get my 240 here. Then cost price. Then I get the total. Then I say 270 minus 240, 30. And then multiply by the cost price, which is 4,000. Then I get my 120,000. Eventually, I add up everything. I get my 1,104,000. That is your first in, first out. I know right now you're saying, Mr. Simbi, let's do another calculation. Do you want us to do another calculation? Okay, let's do it that way. Let's do it that way. Okay, let's go into another calculation. Okay, this one now is an exciting question. It's an exciting question. It would be nice if you have the worksheet with you so that you can follow through what I'll be doing here. This question is adapted from the NSC November for the year 2022, and my focus will be on question 2. Question 2. Are you guys ready? Can you give me a thumbs up so that I can go? Thank you. Okay, let's go. Let's do this. Activity number 2. It reads, Pitten Sports Shop is owned by Miloslav. The financial year ended on 20 February 2022. Powdered energy drinks, 1 kilogram tubs. The periodic inventory system and the first in, first out stock valuation method is applicable. These items have a shelf life of 66 days. Required. Calculate the value of the closing stock on 28 February 2022 using the first in, first out stock valuation method. Okay, let us therefore begin. Let's begin. Information. There is our information. And there is more information being given. Carriage on purchases, the business pays MTY transport a fixed rate of 8 Rand per tub to deliver to the store. Very important. Very important. The cost of delivery. Okay. Returns to suppliers. 30 damaged tubs from January 2022. Purchases were returned to the supplier. Oh, this one is easy now because they're telling us where the purchases are from. But remember, if they don't tell us, is it a problem? We figured it out in the previous question. If they don't tell us that they're from January, where do we look? The cost price. You can see that the cost price were not the same. The other one was 4,100, the other one was 4,000. So you can link those two up. But in this question, they told us that these were from the January 2022 purchases. The supplier reversed the total cost price, excluding carriage on purchases. So the supplier has reversed the cost of the goods, but excluding the carriage on purchases. Okay, let's now go and see what we should calculate. But before we do that, you can see here we have sales and cost of sales. And we're told 925 units were sold and the cost of sales was 4,004,140 after all adjustments were taken into account. Okay, let's quickly go. Question number 1. Calculate the value of closing stock on 28 February using the first in, first out stock valuation method. Okay, so you remember what we did earlier on. I had those 2 blocks such that you can just know this is what we're looking for in units and this is the answer in rands. Let's see if I can have those boxes. There they are. Okay, let's begin then. How many units is our closing stock? That is where we begin, isn't it? How many units is our closing stock? How many units? You would find the information over here. How many units? 235. That means I'm going to come here and I'm going to say 235. We need to know the value in rands. Okay. What else do we consider? Remember what I said, returns. Returns. Let's come to the returns. We are then told that 30 damaged tabs from the January 2022 purchases were returned to the supplier. Okay, so we have tabs that were damaged and they were returned back to the supplier. 30. So we come here now, where? In January. And in January, what do we say? We come and then we say in January, how many units do I have in January? I have, can you say it again? I have 180. But then if I have 180, how many were returned? 30. So do I still have 180? No. So I'll say 180 minus 30. 180 minus 30. How many do I have left after I returned? 150. So I have 150 left. That is very important. Now, once you are done with this one, there are several other ways of doing this question. That is very true. But when you come to your carriage, here is one easy way of going about it. The question wants us to calculate the value of closing stock. It means the amount we paid to buy the stock unit and the amount we paid for the stock unit to be transported until it reached our business. So it includes two amounts. The amount we paid to the supplier in buying and the amount we also paid in delivering this particular item. Remember, when we pay for the delivery of our stock, that will be added to the value of our stock. That will be added to the value of our stock. So in this case, you will see that we paid 8 Rand per tub, 8 Rand per tub for it to be delivered. We paid 4.75 to the supplier per tub when we're buying them. So if I want to add these two figures, I can then say, in January, I paid 4.75. In January, I paid 4.75 to buy a single tub. But I also then paid 8 Rand to have the tub delivered to my business. That simply means per tub, how much is the final amount? It's 4.75 plus 8. How much does that give you? 4.83. That means in January, it is 4.83. Let me explain that again. In January, each tub was costing us 4.75 when we buy it from the supplier. But we need this tub in our business, so we have to pay 8 Rand for it to be transported. So the total cost when the tub is in our business is not 4.75 anymore. It has to add the 8 Rand of having it delivered to us. So it becomes 4.83 then. Are we good? So I'll come here then, I'll say, I need to have 235 units, but we have agreed. Should we start from the top? No, we have already passed that stage. Where do we start? We start from the bottom. Okay? Where do we start? From the bottom. So we start from the bottom and we're going up. Okay? So from the bottom, how many units can we get? Can we get 180? Certainly not. How many can we get? 150. So I'll come here then I'll say 150. Can I go on? So it will be 150. Then I say multiply. What is their cost? Their cost, I have already solved it now. It is 4.75. And then we can also add carriage at the same time, which is 8 Rand. So here I'll have 4.83. 4.83. That is my cost plus my carriage. 4.83. Calculators, please. Calculators. How much do you get? 72,000. Say it again. 72,450. Thank you. 72,450. But I need to have 235 units. So how many more units should I go and check? All right. And then we are going to now say, if I need more units, how many units? I'm going to go to my calculator. On your calculator, you now say 235 minus 150. 235 minus 150. How much is 235 minus 150? Punch it on your calculator. And then you get 85. 85. So you come here and you get your 85 over here. So it's going to be 85 over here. So we'll now say, those 85, they are now going to be from which month? November. Look in the month above, November. So in November, can I get 85? Yes, I can get 85. All right. And then what is their price? Remember, their cost is what? 460. Their cost is 460, but we also paid what? 8 rand to have them delivered. So it's going to be 460 plus 8, making it how much? 468. 468. So it's 85 times 468. Calculators, please. How much do we get? Say it again. 39,780. 39,780. Now, as I said earlier, 85 plus 150, it gives you 235. The number of units. To get the value, we say 39,780 plus 72,450. How much is the value of our closing stock? Say it again. 112,230. 112,230. That is the value of closing stock in this particular question. It is as easy as we have done it now. Okay, you just need to have more practice on this kind of questions. Let's see what more the examiner wanted us to calculate in this question. The next one was saying, calculate the stock holding period in days on 28 February 2022. Use the closing stock figure. So in this question, we were now going to calculate the stock holding period in days. All right. So you have done the stock holding period, and I think you would remember it as the average stock holding period. Okay, whereby you would take your average stock and then you divide it by your cost of sales multiplied by 365, and then you get your average stock holding period. But in this case, we are to use the closing stock figure. That is the instruction of the examiner, not to use the average, but we're to use the what? The closing stock figure. So you need to be very careful as you do these calculations. Are you required to do the average, or you are to use the closing stock figure? In this case, we're required to use the closing stock figure. Who still remembers the value of our closing stock? It was 112,230. Okay, so instead of putting our average stock, we're just going to put the closing stock, and then we divide this. Then we divide it by our cost of sales. There is our cost of sales. Our cost of sales amounted to 404,140. So I'll come here, then I'll say 404,140. Then I multiply this by what? They said stock holding period in days. So the examiner is specific here. They want it in days. So I'll multiply by 365 days. If the examiner wanted me to express this in weeks, then I would have multiplied by what? 52 weeks. 52 weeks. In months, 12 months. But here they wanted what? Days. 365 over 1. Calculators, please. Calculators, calculators, calculators. How much do you get? You will get, say it again, 101.4 days. You get 101.4 days. Already as you are calculating this, you should be concerned that these are energy drinks and they are lasting 101 days in our business. That already is a problem. Okay? But when you are required to calculate your stock holding period, you can have two options of doing this. I call this first method the rand method because here I used rands. So this is the rand value method. The second method is when I use units. The second method is when I use units. All right. So instead of using my rands, let me see what happens if I use my units. Closing stock, using closing stock. So I'm going to take my closing stock number of units. How many were they? 235. So I'll come here. Then I'll say 235. It is still my closing stock. Here I had rands, but here I'm now using what? Units. So you have two methods here. You either use the rand method or the units method. In the units method, I'm saying the number of units at the end is 235. And I divide that by my cost of sales in units. Cost of sales in units is simply the number of units sold. Simply the number of units sold. So it will be 235. Then I divide that by my sales. How many units were sold? It is 925. 925 units. Multiply that by 365 days. Calculators, please. Calculators. What is the answer? Anyone, please? Say it again. 92.7 days. 92.7 days. So here I have two methods that I can use to calculate my stock holding period. I can use the rands or I can use the units. And both my answers would be considered correct. Both my answers will be considered correct. The rand value one and the calculation in units. Both of them will be considered correct. Okay. Now, you can see that we are holding our stock for about 101 days, 101.4 days. And in the next one, we had our stock for 92.7 days. Okay. So, therefore, I think there should be a question that follows such a calculation. Let's see if there's a question that can follow such a calculation. Comment on your findings above. Provide 2 points with figures. Know that the stock holding period for 2021 was 58 days. So they're telling us that in the previous year, our stock holding period was 58 days. But in this year, we've calculated it to be 101, or you can comment using the 92.7. Let's see. Number one, it means the product is not selling. All right, because it is staying in the business for 101.4 days. Let me just going to use 101 days. So the product is not selling. In other words, stock is selling at a slower rate than last year. We're commenting it. You have to know, the longer stock stays in the business, the longer cash stays outside the business, because stock and cash move in opposite direction. When stock is going out, cash is coming in. So when stock stays longer in the business, cash is staying longer outside. So when we have 101 days of stock being in the business, not selling, it means we have tied up our cash in stock. All right, so cash is tied up in stock. In other words, it is now affecting our working capital. We will definitely have some liquidity issues. We may have some liquidity issues. And then this is very important to note, that this is a health product with a limited shelf life because it's an energy drink. So it has to have a limited shelf life. And remember, it's a drink, so it is perishable. And the moment it is staying for 101.4 days, we will end up disposing it because it's going to expire when it's still on our shelves. And being ethically right, or a business that is applying good ethics, we will not sell such a product. So we have to dispose of such a product eventually once it has exceeded or reached its sell-by date. So we can say the stock holding period increased from 58 days to 101.4 days. In other words, it has increased by 43.4 days. If we did the second calculation, the one on units, so remember, this is when you did the rand calculation, this is on the units calculation. If you did the units calculation, you'll be saying it has increased from 58 to 92.7 days. That is, it has increased by 34.7 days. Or you can say it has been on the shelves for 3 months. That is a major concern for us as a business. Or you can say the stock holding period is 35.4 days. That is 26.7 days, depending on the method you're using, above the shelf life of 66 days. Remember, our shelf life is 66 days. And therefore, if you use the first calculation, which is the RAND one, you're going to see that there is 35.4 days above the shelf life period. And if you use the second method, it will be 26.7 days above the shelf life period. Okay, so this is how we would comment on this particular question. All right, let me go on to the next question. The next question was a bit tricky, but it was saying that Milo has noticed that some of the stock of energy drinks has exceeded the shelf life, that is the sell-by date. Identify the value of stock that Milo is referring to. So the idea here is the shelf life or the sell-by date, remember we're told it's 66 days. So it simply means if we are in February, we want to know the stock that has already exceeded the shelf life or the sell-by date. The units in January are still okay because if we purchase them in January, when we're in February, it's only 2 months. So at most, it will be 60 days. So the units in January are still very much okay because by the time we get to end of February, 28th February, if we had purchased them on the 1st of January, they've only been there for about 58 days or 59 days. So they're still below the 66 days. But if we had purchased some units, let's say on the 1st of November, those units have been there from November, December, January already. Those are 90 days already. So these ones would have exceeded. The units from November would have exceeded. But is it all the units? No, because some of the units were sold already. Some of the units were already sold. So we want to know the units from November that have not been sold. The units from November that have not been sold. How many units are those ones from November that have not been sold? Remember, we did that calculation already. And we found that the units from November that have not been sold were how many? Were 85. There were 85 units from November that were not sold. And those 85 units, remember, they were going for what? For 468. I've taken you back now to question number 1. And thereby, you'd find that their value was 39,780. So, Milo has noticed that some of the stock of energy drinks has exceeded the sell-by date. Identify the value of stock. What is that value of stock in rands that Milo is referring to? So Milo is referring to the 39,780. That is the stock that has exceeded the shelf life. That is the stock that Milo is referring to. Okay. And then let's quickly now go on to the next question. And he says, Milo wants to sell the outdated stock at half the cost price. Okay? Stock is already outdated. He wants to sell it at half the cost price. What advice would you offer him about this proposal? Provide 2 points. So this has already exceeded the 66 days and he still wants to sell these units. What would you say to him? He should not sell these products. It may create a poor image of the business. Okay? You should not sell these products because they are hazardous to customers. Remember, it's a health product. He should consider the well-being or reaction of customers before making such a proposal. He should consider the impact it's going to have on his customers. The second point that you could have said is, the business must write off these products as a loss. So the moment they expire on the business shelves, it becomes an expense that the company has to absorb, that the company has to carry. They have to take it upon their shoulders that this loss is ours. We're not going to sell the customers expired products. It is unethical. Okay? So the business must write off these products. And then they must destroy or dispose the outdated products and consider environmental issues. So even as we destroy them, we must do it in a way that will not damage the environment as well. The third point is he must consider the long-term consequences of unethical or illegal actions. So what he wants to do is unethical and it is illegal. And he must take into consideration that once the customers find out, there will be long-term consequences on the business, such as legal action. Lack of continued support from customers because trust is no longer there. They know that if they come by, they may buy expired products. There will definitely be a drop in sales once customers no longer trust the business. He may lose his trading license, and there is a possibility of criminal charges for malpractice. And lastly, customers or the users must be informed of the sell by date. So he must tell them if he still wants to sell them. All right, he must tell them if the goods are going to be sold or donated, or if not considered to be harmful. All right, so this is the last point. But the first 3 points are all saying it must not be sold. These units must not be sold. And he must consider the impact if he goes on to sell these products. All right, we're going to come to our very last activity, which is activity 3 from the Gauteng prelim for the year 2023. But what we're going to do, we're not going to take a 5-minute break. We're going to take only 2 minutes. 2 minutes. So we're going to take a 2-minute break. And then when you come back, we're going to continue with the Gauteng prelim paper for the year 2023. And my focus is on question number 4. See you in 2 minutes. Welcome back, dear learners. I hope you have enjoyed the first part of our lesson. Remember where we began. We began with our inventory systems, perpetual and periodic. Then we went on to the inventory valuation methods, and I told you about the 3 valuation methods. That is your FIFO, your weighted average, and your specific identification. But today, we began with the FIFO. First in, first out. And we discovered that there is no need for us to consider what has already been sold. Let's just focus at the bottom, what we still have on hand. So we've done that with 2 question papers so far, and we have our very own Gauteng paper that we're going to do now. Okay, so if you're ready, let's begin. Activity number 3. All right, this is from the Gauteng 2023 prelim paper. Jonas Sock Company. You are provided with the information relating to Jonas Sock Company. The business is owned by Jonas Nkuna and it sells compression sock for athletes. The business currently uses the periodic inventory system, all right, and the first in, first out method to value inventory. Calculate the following: the value of closing stock using FIFO, stock holding period, use closing stock. Okay, so already you now know what we're going to do. Okay, let's go. Here is the information that we were given. All right, and here we're going to calculate the value of closing stock using the FIFO method. Where do we begin? Remember what I told you. You come and you look at the units that you want. Remember, April is the beginning and March becomes the end of the financial year. So you want the value for your units, the units in March. And how many units do we have in March? You have 2,900. So what we are looking for is that question mark. So I'm going to come here and I'm going to say, how many units do I have? 2,900. Okay, 2,900. And then remember that line, because earlier on I drew you boxes, so now you understand that's not a division line. I'm calculating. All right, and then the returns now, very important. Returns from February purchases. Oh, they told us in this case. Easy now. So where do I go? I go to February. How many units were there? 2,160. How many were returned? 360 were returned. So I'll say 2,160 minus 360. How many do I have left? I'm going to have 1,800. So here I'll be left with 1,800 units. Are we good? All right. So I come here then I say, in February, can I get 2.9? No. Will I take the 2,160? No. Why? Because 360 was returned. How many am I going to get? 1,800. And these 1,800, what is their unit price? Their unit price is 150. So it will be 1,800 times 150. How much do you then get? Say it again. You get 270,000. 270,000. Then we now say 2.9 minus 1.8. What is the difference? 1,100. 1,100. And that 1,100, remember, we start from the bottom and so we're going up now. We are in November. In November, were there any returns? No, I don't see any returns. And then in November, we bought 5,050. So some of them were sold. How many have not been sold? 1,100. So I'll come here, then I'll say 1,100 from November. What is their unit price? The unit price in November is 210. 210. That is the unit price in November. That will give me a total now of 231,000. 231,000. Like this. Calculators now. 231 plus 270. 231 plus 270, that will give you 501,000. 501,000. That becomes the value of a closing stock using FIFO. Okay, can I move on to the next question? Okay, thank you. Let's move on to the next question then. The next question then says, calculate the stock holding period in days. Use closing stock. All right. Now, I'm going to drag it a bit. I want to see if we can use the rand value method and also use the units method. In this question, it's different because we're not given the what? The cost of sales. But let's see if we're able to calculate that cost of sales. Let's calculate cost of sales. How do we do that? We'll say opening stock. Remember, we're told that the business uses the periodic inventory system. So we'll say opening stock, which is your 206,400 opening stock, plus my purchases. My purchases here, I have 3,040,500. But I can subtract my returns. All right, my returns are from the month of February. So I'll say 360 times 150. That is my returns. So you say your 360, all right, 360. You multiply that, 360 multiplied by your 150. How much do you get? 360 times 150. Then you get your 54,000. 54,000. The 54,000, therefore, is your returns. So it's purchases minus returns. I want to see how much you get there then. Remember, your purchases are 3,040,500. 3,040,500. Therefore, you get 2,986. Here is 2,986,500. 2,986,500. So it's opening stock plus purchases. If we had carriage, we would come here and say plus carriage if carriage was given. But in this case, it's zero. That is carriage or customs duty. If with customs duty, would come and add it there. Then you come now and then you say minus closing stock. Then you subtract closing stock. We calculated the closing stock, if you remember, and the closing stock was 501,000. 501,000. This would then give us our cost of sales, which will be 2,691,900. We get our cost of sales here, 2,691,900. Okay, so let's come and do the first method. We want to calculate the stock holding period in days, but we use what? Closing stock. So we'll take now our closing stock. How much is our closing stock? 501. So we'll come in and we say 501,000. Let's divide it by our cost of sales, which is 2,691,900. Then we multiply this by 365 days. How much is it going to give us? It will give you, say it again, 67.9 days. It will give you 67.9 days. This was method number one. Method number two now. Method number two. You can only use one method. Remember, you can't write two methods. You only write one. So it's either you use your rand method or you use your units method. When you use units, you are now saying, how many units do we have as closing stock? 2,900 over cost of sales. How many units were sold? How many units were sold? So in order for you to get the units sold, here it is, given sale of stock 14,000. You multiply this by your 365 days. And then it gives you your 75.6 days. 75.6 days. So your answer is either 67.9 days or 75, depending on the method that you would have used. Okay, depending on the method that you would have used. All right, but I just wanted to show you as well how to calculate your cost of sales. All right, can I move on to the next aspect? Okay, let's do that then. Let's go on to the next aspect. The next aspect was required to calculate some figures. We're told Jonas Nkuna suspects that socks are being stolen from the shop despite security cameras being installed and implementation of proper division of duties. Provide a calculation to justify his concern. So there's a number of ways in which you could have done this. All right, so let's begin with the first way. The first approach is to say your opening stock, which is your 1,290 here, 1,290, and then you now add your purchases plus your purchases, 16,000, all right, and 10 plus 16,010. Then you subtract the units that were returned there, 360 minus 360. These are the units that were returned. And then you now say minus the stock on hand. The stock on hand is how much? 2,900. Okay, and then you say minus again the sale of units. How many units were sold? 14,000. And then you tell me how many units come on your calculator. If there is no stock stolen, your answer will be 0 when you do this method. Your answer will be 0 on the calculator. It means no stock was stolen. But on your calculator, how many units do you get? 40. So that means we have 40 pairs that were stolen. 40 pairs. 40 pairs. These are pairs. 40 pairs that were stolen. The other way that you could have done it is to open a quick account. Okay, so I'm going to just call it a stock account. I'm going to call it a stock account, but this is in units. I'm going to call it a stock account in units. All right, and then I'm going to use OP for opening stock. So it's opening stock, OP, that's 1,290. 1,290, and then purchases minus returns. So you can just have your purchases minus returns already. So here is your net purchases, which is going to be 15,650. I've already said purchases minus returns here. So you end up with 15,650. And then you say your sales were 14,000. So this is your sales here, which is your 14,000. And then you're going to have now your closing stock. Your closing stock, which is 2,900. And then you close off your ledger account. And then the difference would be your missing here. Your difference would be your missing. So in other words, you're saying 1,290. You're saying 1,290 and then plus 15,650. All right, plus 15,650. And then you get 6,940. You get your 16,940. Yet 16,940. And then you say 6,940 minus that one, then you end up with your 40. That is what was missing. So here I gave you again two methods. You don't use the two methods. You choose one, the one that you find is easy for you. Okay? If you use this method, then you discard the T account. But if you choose to use the T account, then that will still give you your number of units that are missing. Okay. Let's go on and see if we have more questions to follow. And then the next question that we're going to talk about now, which is the very last one, is activity 4. It's extracted again from the very same question paper, but this one has to do now with internal control. And let's look at it. All right, this is internal control on inventory. You're provided with information relating to DOS Electronics. The shop has 3 branches and they sell one type of laptop. The owner is concerned that the figures provided reflect poor internal control and decision making. Identify one problem for each branch. So we need to identify a problem for each branch, quote figures in each case, and give advice on how to solve the problem. So this is problem solving then, where we see that there are particular problems within certain branches, and then we need to help them solve those problems. Okay, so here is the information. We have three branches. We have KZN, we have Western Cape, then we have GP. So we want to look at each of them and we see the problems that are there and we assist them in solving these problems. All right, there are problems that normally would come. Okay, you'd find at times it's loss of money, loss of cash or cash missing, loss of stock, that is when stock is stolen, or lost sales. There is a number of problems that we can pick. In next week's class, I'm going to bring you all these problems on one page, then I'm going to go through with them with you. Okay, so let's go first. Let's look at KZN. What problems do we pick in KZN? In KZN. Okay, so in KZN, I think it can be very easy that we had opening stock of 120 and then we purchased 860. So if you add these ones, you should be having 900 and what? 980. And then you sold 885. All right, so if you sold 885, you should not be having 70. You should be having 95 units on hand. You should be having 95 units here. This is what you should be having, 95. But you realize that you're only having what? 70 laptops. So that means there's some laptops that are missing. There is 25 that are missing. 25 laptops that are missing. Okay, let's go and look at that. So you see that there's 25 laptops that have been stolen. 25 laptops have been stolen. What do? We need to do regular stock counts. That is one of the internal control measures that we can put in place. And then we can improve physical security, check at the doors, and then install cameras. All right. And then we can have a senior manager who can authorize the release of laptops. Okay. So those laptops, remember, it is how many laptops that are missing? It is 25 laptops, isn't it? And then each one is costing how much? 6,000. Each one is costing 6,200. So if you say your 25 laptops that are missing and each one costing 6,200, you will see that we have a loss in income of 155 due to the 25 laptops that have been stolen. Okay, so we have 25 laptops that were stolen, which has led to a loss of income of 155,000. If we had sold those 25, we would have received 155. If we had sold those 25 laptops, we would have received 155,000 rands. So that is our loss of income. Let's go on to the next branch, which is the Western Cape. In the Western Cape, we want to see, I'm going to give you a second to see if we have any problems over here. All right. You will see that in the Western Cape, we started off with 250. All right. And then we purchased 1,550 and we only sold 1,200. So we have 600 here on hand. Okay. So we have 600 here on hand. We want to see if we were to sell these 600 units, how long would that take us? All right. So if we want to sell the 600 units, okay, and then in this year we've sold what? 1,200. This year we've sold 1,200. And this year is how many months? 12 months. So what is your answer here? Your answer is going to be 6. So you will see that it's going to take us 6 months. It's going to take us 6 months to sell this closing stock of 600. Okay, so it means we have too much stock on hand. It simply means we have too much stock on hand because we have stock that will take us 6 months to sell it. All right, so here's the calculation that we did. So there's too much stock on hand. What can we do in order for us to reduce the amount of stock, reduce the selling price to increase sales? Or we can find other methods of advertising, or we order as per customer's request. We must not order too much and then we end up having too much stock on hand. Remember, keeping too much stock on hand ties up our cash. So we should only order as per the customer's request. And then lastly, let's look at Gauteng. For Gauteng, already we can see the solution is there, that there is some missing cash. That is 975,000 is missing. All right. The thing is, they were sold, but the money was not deposited. Okay, so you see it by getting the difference of the number of units that were sold, which is that one, by the selling price. And then that will give you 18,850. However, only 17,875 was deposited. So we end up now with 975,000 that is missing. Once cash is missing, we now need to have internal control measures that can help us, such as encourage customers to pay using EFT, request bank notification for all transactions, and use security companies to collect the money, as well as division of duties, whereby the person that collects the cash must not be the same person that does the depositing. All right, division of duties. Remember, you need to expand it so that we can see two people doing separate duties. So problem solving is also going to be part of your inventories. Dear learners, we have come to the end of today's lesson. It has been nice having you. Next week, same time, at exactly 2 p.m., we're going to start, and I'm going to be teaching on the weighted average method, and I hope to touch on the specific identification as well. So make sure that next week you are in this class. Remind your teacher to give you the worksheet, if possible, to have it printed so that it becomes easy for you when we do calculations. It has been lovely having you in my class today, and I hope that you did enjoy my lesson today. Until next time, it is goodbye.